Hey guys, and welcome back to Pay Down Debt Solutions. I'm Jen, and on this channel, we teach velocity banking. So, velocity banking has some key things that it does, and I talk about how your income in and your expenses out is how you win against traditional banks. So, what I'm going to teach you guys today about velocity banking is velocity banking can maximize your savings and your income. Okay, and I'm going to illustrate for you exactly how that happens. So, when you are banking, as you probably normally are, most of you have already started to try the velocity banking way, and I commend you for that. That's fantastic. We get comments all the time about you guys that are, starting to win with velocity banking, and you're seeing your balances, right? You're seeing those debts go down every month, and that's extremely exciting to you because you know that you're going to win and you are going to save more money over the traditional banking system. Okay, so banks make a bunch of money off of us, and we want to minimize how much they're making off of us because we want to put that back in our pockets as our own wealth, right? We want to start collecting wealth, and we can't do that when we're held back through payments and become payment poor. So what I want to illustrate for you guys today is talking about how you can actually increase your income, right? The effectiveness of your income through using velocity banking, and how savings accounts really doesn't, as having a savings account really doesn't do as much for you as you think it is. We are taught inside of the banking system, and that banking system has taught us to keep a savings account. So today I'm also going to illustrate for you using examples on how savings and income in and expenses out helps you win over the traditional banking system when you run it the pay down way, when you run it through our 3-step strategy, which is to organize, identify, and implement a strategy using income in and expenses out and savings potentially if you have it. Maybe we're going to use it, and we're going to talk about that today. Okay, so velocity banking maximizes your savings and your income. Well, how in the world does it do that? Well, in a couple important ways. So first of all, let's talk about if you want to get out of debt, where you put your money matters. Okay, so where you're putting your money makes a big difference when it comes to banking. All right, and if you have debt out there, what you do with your money and where you put it can make a big difference on how quickly you get out of debt. All right, so if traditional banking keeps you payment poor, and we know that it does, what does velocity banking then do for us, and how does velocity banking work? Well, the video I did the other day talked about exactly how velocity banking works. I went through a really long illustration of that with examples. But basically, in a nutshell, velocity banking is putting your income in and running your expenses out of lines of credit and using what is considered a debt as an asset to you, okay, when you run it the correct way through velocity banking. Now, traditional banks don't provide a way to relieve payments unless it is through another loan, okay? And let's be honest, loans are self-serving for the bank, right? Because when keeping a loan on deposit with the bank and you're adding to its profit margin through a spread that it makes on your loan. So when you talk about assets, right, an asset to you would be savings, okay, maybe a vehicle, something that you can sell and get money for. All right, investments can be an asset to you. Your house could be an asset to you, depending on if you have a loan on it or not. Now, when you are a bank, your assets include loans, okay? And those are loans that you have loaned out to others because they're paying you back interest, which then becomes an asset, right? So banks want your loans. So you bet your bottom dollar that they want you to make those payments, and they want you to make those payments for longer. Because the longer you have that loan, the more stability they have, right? Because they're earning that steady income off of you. And it's time that we change that by using lines of credit, okay? So if banks advocate for keeping 3 to 6 months, okay, if you're supposed to keep 3 to 6 months of bills in your savings account at all times, that is self-serving for the banks, right? It is not so much self-serving for you, and I'm going to show you that in just a second here. So if you, who tells you that we're supposed to keep 3 to 6 months on the bank, on deposit with the bank as a safety net, right? As a security? Well, banks teach you that, right? And people that are taught by the banks are telling you that, right? So some of these investment advisors out there will teach you that. some of these these people that teach you how to, run your finances, and they're going to show you, a better way of running your finances, and maybe you're paying them a monthly fee to do so. Okay, so maybe you're doing that. Well, you guys don't need to do that, because you're going to learn velocity banking, and you're going to learn that you can wrap all of this up in a pretty bow by using velocity banking. All right. So we are not going to keep 3 to 6 months in savings if we have a line of credit available to us, because that line of credit that you have is your emergency savings. You don't need an emergency savings when you have a line of credit that you can pull cash off of if you need it, okay? And it's smarter when you take a look at this example here, okay? So if we have a savings account and we are earning interest, about how much interest is a typical savings account earning? It's earning 0.01%, okay? So most of you out there that have a checking account paired with a savings account, if you could leave a couple thousand in there, you're earning 0.01%, okay? 0.01%, all right? And if you're earning 0.01%, you know that, let's say you have $15,000 in the bank, okay? And we know it's earning that 0.01%. Well, if you multiply that out, and your APY, right? If you multiply that out, you're going to have to move your decimal, right, over 2 spots. So you're going to be at 0.0001, okay? So if you multiply that 15,000 by 0.001, that means that you are earning $1.50 for that savings account for the entire year. All right. So that means that you're at a $1.50 APY, and you're earning approximately 12 cents a month on that interest, okay, as interest, okay? So thank you so much, right? The bank is paying you 12 cents on, a month, but they're going to turn around and they're going to charge you how much for the loans that you have on deposit with them. Is that fair? When you really think about it, think about the spread that they're making versus what they're giving you, right? It's ridiculous. And that's why when you learn velocity banking and you learn to run things a different way, and you learn to kick that traditional banking system, right, their strategy, being inside their world, right? When you learn to kick that to the curb and do things through velocity banking, you always win, all right? Okay, so let's look at debt interest here. So let's say, right, you have your savings account, $15,000, and at the same time you have that savings account, you also have some debts out there. And let's say you have a credit card for $2,500, and it's at 21%, and that means, let's say it's $525 annually. Okay, so let's say that's how much it would be in 1 year. It would cost you that, right, at 21%. And then let's say we have another credit card out there for $3,100, and it's at 29%. So that means the interest on that is going to be approximately $899 annually, okay? And then let's say we have another loan out there. Let's say it's a line of credit, okay, for $9,400, and it's at 13% interest rate. All right. And that means that you're going to pay at the 13% rate $1,222 annually. All right. So that means in just 1 year, okay, in just 1 year, we don't know what the payoff yet is. Okay. We don't know what the term rate is, but we're just taking 1 year at a time here. And let's say in 1 year, we're going to pay $2,646. Okay. So for that $15,000 in debt that you have, all right, you're paying $2,646 to the bank. Year 1. Here, you're making 12 cents a month or $1.50 a year. There's a problem with this, isn't there, right? If you take a look at this and you realize this $15,000 is sitting there earning you nothing, right? Nothing, but you have to have 3 to 6 months on deposit with the bank in case of an oh shiznit moment, right? Because that's what we're being taught by these traditional banks. The traditional banking system is holding us down because they're telling us to do things like this. And that's ridiculous when you're going to turn around and pay $2,600 in interest for 1 year. Now, let's multiply that out. Let's say these term rates take 4 years. Let's say, just hypothetical, let's say it takes 4 years to term these loans out, okay? So if we, just an approximation here, take that, okay, and multiply it, we take the 2646 and multiply it by 4, that means the interest we're going to pay is $10,584 in interest. Wow, right? $10,584 over 4 years, when we could have taken care of this debt in about a minute, right? And then the cash flow that we would get from that we could then turn around and put that in savings once we don't have any debts, right? That would just seem to make so much more sense because you can make a better decision with that savings that you're going to be having at that point. You can make a better decision with it when you're not stressed and you're not strapped and you're not worried about your debts, right? Because I know I make better decisions when I'm not stressed. All right, so in terms of that, right, in terms of looking at your income, okay, and your savings. So right now we talked a little bit about savings and what savings can and sometimes cannot do for you, right? But now let's talk about what happens when we take our income in to a debt weapon, a debt destroyer, a debt tool such as a line of credit, okay? And then we run all of our expenses out of that. Well, those of you that have been following the channel, you already know that when you take your debts like this, okay, and you no longer have those payments that are being made because you're putting them inside of a line of credit, all of those payments then come back to you as income or reduced expenses, depending on whether you're running a credit card or whether you're running a line of credit. And so if this is a personal line of credit, you're going to get reduced expenses, which means all of that comes back and works down your line. And how much quicker does it work down your line? That's what we're going to talk about. So here I'm taking an example here without using our savings, okay? We're talking about here in this example, and then I'm going to erase the board and show you the rest of the examples. But in our first example, we are taking velocity banking to maximize our income, right? So we're going to maximize our income and we're not going to be using the savings. So in this scenario here, and this is a hybrid of a student scenario that we have going on right now. So I just took a hybrid version so I can really show you guys the difference when you take a savings account and you use it for your advantage and you also pair it with your income in and expenses out, such as we do with velocity banking. All right, so in doing this scenario here, we have an income of $4,200. We have total expenses of $3,860. That means our cash flow is $3,040. I'm sorry, $340. I wish it was $3,040. All right, 400, I mean. So it's $340. And let's say we have a mortgage at $1,157, okay? So their mortgage is $1,157. We're not dealing with the mortgage here right now. It's just one of our expenses that we have. But we have a Chase card at $2,500, right? Talking about this here. Chase card at $2,500 with a $50 minimum payment, okay? And if we let that term out at 21%, it's going to take 10 years and it's going to cost us $3,493 to pay that back. So then let's say we have our Discover card and it's at $3,100 and it is at $80 as a repayment. Okay, so the payment monthly is $80. That is a minimum payment. It is at 29% for a 9.8-year term. Okay, that is going to cost us $6,133 to term out. All right, so now let's say we have a personal line of credit. Okay, so we have a personal line of credit. We have $9,400 on that personal line of credit. We have $196 payback at 1% plus interest. And it's, again, at 13% interest rate. It would take us 5 years and 9 months to pay it back this way, okay? And it's going to be $3,939 to term that out, all right? So what does that mean in terms of how much debt we owe, right? So right now we owe $15,000 in debt, not including our mortgage debt. So $15,000 in debt. We have a payment of total of $326 between these three. And to term it out, it's going to be $13,565 for $15,000 in debt. Now, this is where the power of velocity banking comes in because there's no way I'm ever paying this again. Not since I've learned velocity banking. I am no longer going to be tripped up and tricked by these banks. I am going to be smart about my money, and so are you, right? So let's say these people have a savings of $2,600, okay? We're just going to say that that's what they have, and we are not going to use it in this scenario. We're going to leave it sit there because certain gurus out there tell us that we have to have money on deposit. Okay, that's fine. So we're going to leave it there. And our personal line of credit is a maximum line of $15,000, okay? So that is the max line. But because we have a savings account that we're leaving there and we're not going to touch, we're going to go ahead and we're going to take all of this debt and we're going to roll it into that line of credit. So what happens when we do that, right? So what happens? Okay. So when we run this, we know that we're taking the entire dollar amount of $15,000 and we can put all of our income into this line of credit, can't we? We can put all of our income into that line of credit because when we use lines of credit, we can put our entire income into that line and run our expenses out of it, okay? Because what happens is that money, our direct deposit, comes into our checking account, right? For about a minute. We then make a payment onto our line of credit, that personal line of credit, of the entire amount of our income. That seems really scary, doesn't it? But don't worry, because we are going to be using that line of credit to pay for all of our living expenses, okay? So we take and we make a payment of $4,200 onto that line of credit. And then throughout the month, we are going to be paying our expenses through using that line of credit. Because what happens? Your bills come out of your checking account at this point, but they're being covered by that line of credit. So they're being drafted from that line of credit, going into your checking account for the split second it takes to pay that bill and moving out to pay it, okay? Or to pay the expense or other line amount or whatever you have going on, right? So your expenses are being paid that way. So when we do that, what happens is, because lines of credit are figured on an average daily balance, that huge deposit of your income or that huge payment of your income drops our balance very quickly, okay? So that means the interest that we pay is going to drop dramatically, which also saves us money. Remember, income in, expenses out, using simple interest and dropping our interest quickly, using the freed up cash flow, right? Because this is now become cash flow. It has become cash flow, and it's coming back to us. So we had $340 in cash flow. Now we can add the $326 to it, right? So we have over $600 of cash flow, but we do have to pay interest, don't we? Because we're using that line of credit, and that line of credit was at a 13% interest rate. So we have to then calculate our interest. So how do we do that? So how do we know how quickly we're going to pay this off? How do we do that? Well, what we're going to do is we're going to take our high balance and we're going to take our low balance, okay, for the month. So we take our high balance of that 15,000, okay, and we add it to 10,800, and that's going to equal 25,800. We divide that by 2, and that's 12,900. And then we're going to multiply that by 0.13 to give us 1677, and then that is going to be divided by 12 because we only need 1 month. The number before that, right? That would give us, I think it was 13 something. That would have given us an entire year at that interest rate, okay? But we only want 1 month of it because we know that when we're putting our income in and we're paying our expenses out, our income is going to take care of that and drop our interest rate for us. So each month, this interest rate is going to go down if we're running our banking properly and we're not overspending. Now, you might have an oh shiznit moment, right, where you have to buy something or something breaks and you have to fix something, and you might have a month where that goes up. And that's okay, because with Velocity Banking and using lines of credit, we have a cushion there, don't we? So if something happens and we have to spend a little bit more money, that's okay. We can survive it now because we're doing banking a little differently. All right, so this scenario here is going to run, and we're going to see how quickly that runs down. Okay, I have 3 of them that we're going to do. This is scenario 1 here, and it's not using the savings account. I'm then going to run one for you that shows what happens if you use your savings account, what that looks like. And then we're going to run one using a 0% credit card, a balance transfer, because I love balance transfers, and we're going to see how all of this plays out. So give me a second and I will write that on the board for you. Okay, so I'm back and I finished the board here, and we went over our first scenario here, which was where we took 0 savings. Even though we have $2,600 in savings, we took 0 savings to get this done, okay? And I will reveal for you how long that took, okay? Lots of antics going on outside my window here. We've got we had our septic pumped, and then Dan and my daughter are covering the hole back up. So you probably heard some interesting noises from the tractor and everything. So I apologize for that. So anyway, so now we're going to go into scenario 2 here, which is to use the savings as well as that line of credit. Now remember, when we use the line of credit, we're getting back the $326 that comes back to us. So that's where this amount comes from, okay? Our total expenses minus these charges, which are, or these payments, which are no longer involved in our expenses, right? So those came off of the top, they came off of our expenses. All right, so now when we run things this way, so what happens, okay? So now we are going to use the savings account money. And so we then are going to take the $2,600, we're subtracting it from the 5,000, or I'm sorry, the 15,000 to give us 12,400. So 12,400 is our new dollar amount that we're going to work with in using the savings so it doesn't sit there earning us $1.50 a year, right? So we don't want it to earn us $1.50 and pay more out in debt expenses, right? Debt interest. So we're going to get smart and we're going to use it in this case, okay? So we're using our savings account and we then have 12,400 that we're working with. So here's the 12,400. We subtract out the 4,200, which is our income. That drops our balance to 8,200. But our expenses have to come out, right? And so does our interest, all right? So our expenses and our interest come out. The interest is at 311. And then as the interest comes back in and the expenses come back in, that puts us back at 11,831. Again, our income comes in. Remember, you guys, it's income in, expenses out, and that is how we win, right? So the income comes in, expenses come out, and that then takes us for month 2. We drop to 7631, but then after the expenses and income come out, we're back up to 11,256. Okay, so that is using the savings account. All right, so that's what happens when we use the savings. Now, one other thing that we could do, because I am an advocate for 0% interest cards, I absolutely love them. I think they're a fantastic way to save yourself, right? To save money. So this is a way that you can make your income and your savings work more for you by taking advantage of the 0% cards, okay? And yes, they do have a fee, but we're going to see how impactful those fees are or are not at the end of the day when we look at how much they have this all has cost us, okay? So here we're using savings and a 0% balance transfer. So we're going to use both. So now if we take our $15,000, right? And we subtract off our savings and then we put all of this, we're going to use a 0% credit card along with this, right? So we have a convenience check at 4%. So we're going to run it on the high. Convenience checks can be as much as 4%, as low as 2%. So if this was at 4%, that means that we then have to take our 12,400, multiply it by 0.04, because we have to turn it into a decimal, and then we get $496, okay? So there's your 12,400 plus the 496, which means we're going to be running this for 12,896. That is the amount that it is going to be run at, okay? So 12,896, we're going to subtract out our income, and then it drops our balance to 8,696, and then we have our expenses, right? Our expenses have to come out, and we are not adding back in any interest, are we? So there's no interest, all right? So again, we're going to run this again, and so the next month, as our expenses come out, we're at 12,216. If we do our checks to make sure, are we going in the right direction or not? Well, we started with 12,896. After our expenses came out, we are down to 12,060, or we are back up to, I should say, we're back up to $12,216. So that is lower than what we started with. We are going in the right direction. All right, so again, our income comes back in. Our $4,200 comes back in, drops us to 8,016. Our expenses come out, but we're not adding any interest in, are we? So that means we're at $11,536, okay? Now, this, I'm going to tell you how long that this takes, okay? This ends up taking us 13 months, all right? So it takes us 13 months, and the balance at the 13th month, or starting the 13th month, now remember, if this is a 0% card and it ends at 12 months, what then happens? Because we have a balance starting the 13th month at $4,056. Well, when our income comes in, which is going to be, you can't overpay the card, right? So if our income is $4,200, we put $4,056 on this card. That means we pay 0 interest. No interest is involved here because we've paid the balance, the statement balance off. It's paid off, okay? Now, and then of course you'll have to run it down to then eventually get the expenses out of it, right? And it doesn't matter, you guys, because when your income is coming in, as long as the income covers the charges that are being charged monthly, and they are, right? See how the charges are being covered? There isn't going to be any interest, all right? Because some people have said to me, yeah, but when you have a balance transfer and you have money on a balance transfer, anything above and beyond that is subject to interest. You're right, it would be. But you have a bucket that's at 12,400 or 12,896 in this case that isn't being charged interest on it, right? But every time your income comes in, it's satisfying anything you've charged on it monthly, right? So the income is satisfying this, meaning you're still at zero. Okay, so you aren't paying anything above and beyond that. So in our big reveal, so what do we have here? Okay, so when we do the first scenario here where we took zero of our savings and we just left it out there for the the oh shiznit, right? The what if. Okay, we left some what if money for $2,600. Now, if we left that, it was going to take us 18 months and we were going to then spend $1,577, okay, without using the savings. We would have spent $13,565 if we let this term out. If we didn't pay any extra and we just paid our minimums and let them term out, it was going to take $13,565 of our hard-earned money. We were going to just give it away to the banks, right? Right? Are we going to do that anymore? Probably not. I'm not going to. I know you're not going to. All right. So then now if we used our savings, right? So in scenario 2 here, we decided we were going to use some of our savings and then we were going to run the remainder through Velocity Banking into that personal line of credit, okay? So that scenario then was 14 months, okay? And we spent $970 to do that, all right? So we went from 19 months not using savings to 14 months using savings, cost us $970. And now we're going to talk about the 0% card, okay? So here's our 0% card. We already know it took us 13 months to do, right? And we know that it still didn't cost us money, even though there was a balance left over in that 13 month because our income came in to take over and satisfy that, right? So that means you spent 13 months to do it at 0% and all it cost you was $496. So it cost you just that convenience check fee. All right. So again, how is Velocity Banking worthwhile? What makes it worthwhile and how is it powerful? It is powerful because simple interest, using lines of credit, your income becomes maximized because you no longer have payments anymore because you are putting those into that line of credit and that line of credit is taking that extra money you have and working down your balance because you're smart and you're putting all of your money into that line. Now, that might make some people nervous, right? To put all of their income into a line of credit. And, then you think, well, I don't have any extra money left over. But you do, you guys. You have money left over because that line of credit then is working everything down and everything that is released back to you as cash flow then becomes cash flow and you have extra money in case of a what if situation. Don't leave $15,000 sitting in a bank account for 3 to 6 months because somebody told you to. Don't do that anymore. What sense does that make? What sense does it make when you're running at 23% in credit cards, 29% credit cards, 30% credit cards, 13%, when you're running cards that are high or loans that are high and you can defeat them, then defeat them and do it through Velocity Banking. Thanks, you guys. I hope you've learned something today. If you have any questions, let us know. You can always email us at info@paydowndebtsolutions.com. We always answer questions and we're always paying attention to your comments. Have a great day and we'll see you soon.